Ladies and gentlemen, welcome back to the channel. Today we're going to be talking about algorithmic stablecoins. I think I'm going to call this video Algorithmic Stablecoins Explained. I have been able to earn some incredible profits investing in algorithmic stablecoins, but it's important for you to understand what they are because almost all algorithmic stablecoins have failed. However, if you understand how they work, there is a possibility to be able to invest in them at the right time and be able to earn some insane profits. So I want you to understand what they are, how they work. Nothing in this video is considered financial advice. I'm simply a cryptocurrency enthusiast and a YouTuber. I love this stuff. I love algorithmic stablecoins because I believe in the future we will have this technology perfected. Again, I can't say this enough without enough caution. At this point in time, there's not been one project that has shown a true, full algorithmic stablecoin that is uncollateralized that has succeeded. So it's important for you to understand that. Now, there's a difference. We're not talking about USDT here. We're not talking about USDC. Those are all well-known stablecoins. Another one would be BUSD. But every one of those stablecoins are supposed to be backed one-to-one with collateral. That's what's holding them basically to peg. The idea is people have trust that if the crap hit the fan, so to speak, they could redeem that $1 worth of stablecoin for an actual dollar worth of value or dollar itself. Algorithmic stablecoins provide no backing. Instead, they have an algorithm mechanic in place that should, or the goal of the protocol is to be able to help keep the price pegged. In this case, we're talking about stablecoins, so we're talking about keeping it pegged to $1. But it's important to understand, and that's the peg price right here, but it's important to understand that algorithmic stablecoins don't have to be pegged to the dollar. They can be pegged to Bitcoin. They can be pegged to Ethereum. They can be pegged to anything, however the protocol is set up. But it's important that you understand how these mechanics will work. Now, this is going to be a short playlist on my channel because in this video, I'm going to be talking about algorithmic stablecoins and explain the basics of how they work. I'm going to talk about in the second video the number one thing that you have to be careful for with all algorithmic stablecoins, which is the death spiral. I'll talk about what causes that and why, and how some protocols are always working to prevent that. And if they ever do prevent it, we will have an incredible project that could be around for a really long time. And number three, I'm going to talk about, even though this is a high-risk project and a high-risk mechanic, the strategies that I like to use personally to be able to profit from algorithmic stablecoins. And I've done incredibly well personally. There's a project called $. I put in $5,000, pulled out $20,000 in less than a month. There was a famous project that Mark Cuban made famous because he got crushed. It was called Iron Finance. That was also a version of what I'm going to show you today. I actually made insane profits on Iron Finance, like insane. But because I understood what I'm going to show you today, I was able to get out literally the day before because I saw something that wasn't looking right in the ecosystem. And unfortunately, Mark Cuban did not, and he got crushed, and he ranted on Twitter all about it and that sort of thing. So if you want to be smarter than Mark Cuban, watch this video. Algorithmic stablecoins, again, ideally they're pegged to $1. Now, why am I talking today about algorithmic stablecoins? Two reasons. First of all, I believe this is a technology that we need, and I believe it's a technology that if people understand it, they can make a tremendous amount of profit. In fact, I have a video. It's not about algorithmic stablecoins, but if you love talking about passive income and you love earning money in cryptocurrency and you believe this technology is the future, do me a favor and smash that subscribe button. You can also go down in the description and subscribe to our free video course that's going to be launched soon. That's going to reveal a little known method to earn $1,000 per day with cryptocurrency. And literally nobody's talking about this right now. So go ahead and put down your name, your email, your phone number, and stay tuned for that. With these algorithmic stablecoins, there's always a kind of a 3-token system. There's a peg token, a share token, and a bond. Peg tokens are pretty straightforward. If we're just for example's sake, we're going to say the peg token is pegged to $1. There's two more terms you need to be aware of. It's called epoch and TWAP. Epoch, E-P-O-C-H. Epoch is a time period. The way they calculate what the peg price is for the purpose of the algorithmic, what's called I can't even say it right. Seigniorage. There you go. Seigniorage supply. Seigniorage is just the profit that banks make by creating money, literally the amount of money that the banks make for creating money. But in an algorithmic stablecoin, investors earn the seigniorage. So we'll get into that here in a moment. So every time price is above peg, they print more tokens. That is the seigniorage supply. the way they calculate when, it's not like it's every single time the price ticks above peg, they suddenly start printing. What happens, the algorithm has a epoch, and typically it's 4 hours or 6 hours. I've seen it as long as 12 and 24 hours. During that epoch, the average price of the peg token, these peg tokens always have different names. It may be basis dollar, it may be anything, B dollar, it may be EMP token. All of these peg tokens have a different name. And what happens is they take the average price during the epoch, and that's called the TWAP, time weighted average price. So the time weighted average price of the previous epoch determines if they're going to print more tokens. If that time weighted average price is above peg, then more tokens will be minted. In other words, there's going to be a seigniorage. If the price is below peg during that epoch, if the time weighted price is below peg, then there are going to be no more tokens minted and bonds can be purchased. So we'll talk about that next. But first, let's talk about what happens when there's tokens minted. Where do those tokens go? They don't get dumped on the open market. The theory or the idea is they go to people who have belief in this system. They go to the investors that want to basically hold this system together, and they have a long-term vision. That was the idea when this was created. Now, I will tell you, it doesn't ever actually work that way. Historically, it has not ever worked that way. But what's supposed to happen, let's just say that the price is, instead of being $1, it's $1.05. Now, mind you, sometimes I've seen as high as $4, $5, $6, $8, $10. That's crazy. When that's happening, I'm going to tell you, you can bet that the project is going to possibly crash, but we'll get to that in another video. But anytime the price is above peg, there's an additional supply of tokens that are just printed. But where do they go? They go to everyone who holds the share token. Now, just for holding the share token, and typically you have to stake it on the website, and it'd be called the boardroom or something similar. Just for staking the share token, you earn when the TWAP price is above the peg price, meaning the time weighted average price is above peg at the end of an epoch. And there's typically a countdown timer somewhere. The people who hold the share token, that's where you can, when you hold share tokens, you can make a lot of money. I mean, a lot of money. It can be risky because the share token prices can be insanely volatile, because anytime that the price is below peg, then oftentimes the share token prices will drop. But when that price is above peg, and more people finding out about a project, they're going into the project, they're buying that peg token, that token price can go up, 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 which means every epoch they are printing a lot of tokens that oftentimes are still carrying a value higher than $1. I mean, it's crazy. It's crazy how much you can earn owning share tokens, as long as you don't get stuck holding the bag when the musical chairs stop. Now, that's what happens when the peg is above, the price is above the peg. Now, what happens when the price is below the peg? This is where most of the time this mechanic has problems. Very rarely do these mechanics deal with price being below peg very well or very often. They do much better when price is above peg. But when price is below peg, there's not going to be any more tokens minted. No one in the boardroom or no one holding the share token or staking the share token, they're not going to get any additional tokens at the end of the epoch. And what typically will happen is bonds will go for sale. So bonds are sold, or another way of saying this is bonds can be bought below peg. Sorry, if this token is below peg, you can actually take the token and buy one bond when it's below peg. The idea is you're actually burning the supply. So when it's above peg, they print tokens and those tokens go to the shareholders or the share token holders. You're increasing the supply, which should bring the price down. But when the peg price is below $1, then we need to get the price up. We got to decrease the supply of tokens. And it's absolutely fundamental that you understand the basics of when you increase supply, you decrease price. And when you decrease supply, you increase price. That is the fundamental that we're working with here. So the peg token goes down. We got to get rid of the whatever token, fantasy $1 token this is. What we need to do is burn the supply. The way we do that is we allow people to use the peg tokens, and I say we as in that's how the protocols work. They allow people to take the peg token and exchange it for bonds. So the peg token might be trading for 98 cents per token when it should be at $1. It could be trading at 95 cents per token. The idea is you can take those tokens and you can buy bonds. Now, when you buy bonds, you can't do anything with them right away. But if and when the peg goes back above $1, and let's just say the peg goes up to 1.03, at that point, bondholders can normally sell their bonds at a premium. So instead of 1.03, they might be able to sell them for 1.04, for example, or 1.05. And every protocol is a little bit different. If this mechanic works as advertised, it will hold the token at peg. But invariably, there's something that happens, and it's called a death spiral. We're going to talk about exactly what is a death spiral, what causes a death spiral in the next video. So make certain you subscribe to the channel, click the bell notification icon, and click all. Decentralized cryptocurrency equals freedom, ladies and gentlemen. This is Crypto Wealth. I'm out.